of overpaying is much less. And as I say, that again, for me anyway, is a source of encouragement. No doubt, however, valuations do count, and it's our job to try and help all of us navigate the short term a bit better. You saw in that previous slide that valuations do matter in the short term. And what we can say is that optically, valuations look quite a bit better, virtue of the falls we've seen year to date. So here's the trailing PE of developed market equities, and it is now below that 5-year moving average. The same is true for emerging markets, now below the 5-year moving average. So valuations look good, but when we think about margins, what we're showing here is return on equity, how profitable our business is, we have not seen that come down despite all the headwinds that companies are facing with falling demand and rising costs, both in terms of capital and labor. So that hasn't come down in DM, that hasn't come down in EM, and we think it will do in the next period. So that's a concern. The question then, most importantly, is the bad news, is Putin's war priced in? And we can conclude that no, it's not, unless you are bullish. What are we looking at here? We've got 4 scenarios. First column, that is the base case. That's essentially anchoring to long-term valuations. So if you're going to simply look at valuations where returns across equities and parts of the fixed income markets, they look pretty good. They're largely green. If you take scenario 1, that bull case where we get little to no recession, then again, returns look pretty decent. Hence, if those are the only 2 things you're thinking about, then now is probably the time to go overweight. We, on the other hand, well, we don't think scenario demand capitulation is particularly likely. We put a reasonable probability on scenario 3, which is lingering supply constraints and hence lingering inflation. As I say, this is about the supply side of the economy. If it doesn't get better, we're going to have issues. And so we put a reasonable weight on scenario 3, given that now is not the time to be overweight in our view. It's not the time to run for the hills, absolutely not. We take a lot of encouragement from long-term valuations, but on a shorter-term view, these shorter-term scenarios 1, 2, and 3, they lead us to think that we should still be reasonably cautious and build in a reasonable amount of protection against inflation. One of the questions we had ahead of time was, is it time to load up on tech and growth stocks? Because of course, they've fallen a huge way this year with the rise in the discount rate. All these 4 charts are showing you is that the value cohort of stocks still looks a lot more attractive than that traditional growth segment. We do think there are good opportunities in the growth market, but we think you need to be nimble, and hence I'd suggest you think less in terms of growth and more in terms of momentum managers. And happy to talk to any of you more about that distinction at another time. Again, as it says here, if one is concerned about rising real interest rates, well, real interest rates look very low, as we'll go on to show, then one wants to be in areas of the equity market like the UK, emerging markets in Japan, and again, you want to continue favouring value over growth. So back to that previous story, no, we don't think it's time to load up on growth. To be clear, there's a lot of numbers on this slide, but essentially you're looking for the green areas. They're telling you where you'll do relatively better should we see real yields go higher. Right at the bottom line, you can see growth and value. Growth has a 90% correlation to those real yields. Value much lower at 46%. Right, I'm doing okay for time so far. Also, I've said that we don't think it's the time to load up on the FANGs, for example. That doesn't mean there are opportunities. There are a lot of idiosyncratic opportunities in our portfolios. One of those are certain listed private equity vehicles we've identified that we think offer decent opportunities from here and are trading on nothing like the valuations of the FANGs. So there are always opportunities. Obviously, we had the question about inflation. I hope this chart talks speaks for itself. The market expects inflation to drop dramatically. The red line is obviously where we are. The market implied that grey line, that's where everyone thinks we're going to be in 1 year's time and staying low thereafter. That looks to us an aggressive assumption. Where do you want to be on the balance of probabilities? Is there a chance that that grey line is actually materially lower, or is it more likely that it might be somewhat higher than where it's priced today? We certainly think the latter. As I say, in terms of the balance of probabilities, we don't think it's worth buying into this at that kind of a low level. That's not to say that we think inflation is going to get massively out of control from here. It has most likely peaked. Some of the things we follow, you've seen this decline in shipping rates. That's important. Global trade and input prices. Similarly here, we are seeing firms passing on less of this inflation in the form of rising wages. So this is a positive. All this chart does is compare where we were in December 21, where firms were responding to labour shortages by really aggressively increasing wages. That dynamic has shifted come April of this year and continues to trend lower. So wages are rising, but we think reasonably contained. The next question then was on US interest rates, and I've drawn exactly the same type of chart. What we see here in red is the long-term history of US real interest rates, and then we can see where the market thinks real interest rates need to be in the coming 5 years, 10 years in fact. And again, we've seen in that previous chart, the market thinks inflation is going to come down dramatically, and yet it thinks we really don't need very high real interest rates at all to achieve that. Instead, interest rates on par with the post-GFC era, that's going to be sufficient to bring down inflation from this multi-decade highs. That to us seems, again, rather likely. Again, on balance of probability, do we want to be buying into rates at these levels, expect them to go lower, or do we want to underweight them, expect them to go higher? It is the latter. Next question was on the dollar. We've seen this period of dollar strength. What's the outlook from here? Currencies are very difficult to predict. About a year ago, you might have caught my presentation on currencies and about the fallibility of the different rules that people use to try and gauge which way currencies are going. When we look at currencies, we do try and keep it simple. The dollar is expensive on most real world metrics, i.e. what can you buy with it versus what you can buy with it, 1 yen or 1 euro. Anyway, it looks expensive on that basis. And similarly, the impetus behind its most recent rise, that is US monetary policy tightening more aggressively than elsewhere, that is likely to fade as we go through the next 6 to 12 months, i.e. in the next 6 to 12 months, it's possible that Fed tightening is largely completed. Recession risk, absolutely critical, and there's no questioning the fact that, as it says at the top there, war has hindered global growth while aggravating inflation pressures. I say threading a needle at the top of this chart because essentially I do think it is a bold assumption to say that central banks are going to manage to engineer a slowdown without economies experiencing a recession. As you can see here, it says 11 out of the past 14 tightening cycles in post-war history in the US led to a recession. So history is against you. I think the logic of what the Fed is trying to do in terms of controlling an economy of around 300 million people, I think that would also tell you it's a very difficult balancing act. So are we going to get a reflation? Well, reflation. Are we going to get a recession? We may well already be in a technical recession. I don't think it's a case of binary, are we going to get one or are we not? I think it's really about the depth and length of any recession should we get one. And thinking about that, we're reasonably optimistic. As it says here, a hard landing is not inevitable. A hard landing, let's call it a proper drawn-out recession. It's much easier to avoid a recession when the private sector financial balances are as high as they are today, i.e. we're seeing decent household balance sheet strength. That should help stave off the recession. People can dip into savings, people can keep spending. This slide says exactly the same thing. Households enter this tough period in pretty decent shape. Most people have jobs. There is still some excess savings out there. The same, thankfully, is true of companies. Companies enter this period in reasonable shape, and they can certainly cover their interest expenses. You've never seen a period like it where interest rates and interest bills on companies' balance sheets are as low as they are today. It's very easy for companies to cover those expenses. Yes, those expenses will rise. Yes, there'll be some casualties, but we're looking here at the broader picture, and the broader picture is that companies are in reasonable health. And finally, then, geopolitics, because one does need to think about these things as we've seen this year. They are critical, certainly in the short term. Number one, this fellow is very unlikely to go anywhere. Number two, we think the energy supply issues that have obviously emanated from Russia's invasion, we think they will prove transitory. We see this as an acute problem in Europe this winter. We see it gradually fading as an issue thereafter. And that is because, obviously, Europe is already scrambling to rebuild stockpiles to find alternative supplies, be that from Africa, be that from Australia. It takes about 5 years, but they'll build some new LNG terminals. There are plenty of options. We think this issue will gradually fade without saying anything about the war, which unfortunately is likely to be a drawn-out affair. So that's Russia and Ukraine. Next up is obviously the question of China and Taiwan, and what read across we in fact take from what happened earlier this year in Ukraine. The point this slide is making is that China, in terms of its relationship with the West, looks quite different from Russia. Russia lived and lives even more so now in blissful isolation. That is not the same of China. China is deeply integrated into the global economy. China, as you can see here, supplies about 18% of US imports. An invasion and the isolation it would bring from the West would hurt them acutely, and hence is absolutely not in their best interests. Summarizing our view as clearly as I can on this slide, first of all, when people think about this issue, they tend to then question our positions, both in equities and on the debt side. In China itself, what I'd say to you, if you're worried about China invading Taiwan, it's going to have much bigger implications beyond your positions in China. It's going to cause massive ructions around the world, and there'll be very few places to hide. Number two, fool me twice in this regard, obviously. We've had what happened in Russia. Are we going to be wrong again? Well, three, we still think it is unlikely. Point four, not only is it logistically very challenging to launch an amphibious campaign against Taiwan by what is actually a very inexperienced military in the form of China, but most importantly, number five, why would China do that when their long-term policy of exerting soft power and growing their international influence is absolutely working, particularly as a result of actually what's happened in Eastern Europe and the fact that the West doesn't want to buy European energy. It means China is now in preeminence or predominance in terms of its energy position. It's in a much better place than the US is, and that wasn't the case going back a few years. And similarly, it's helping to internationalize the renminbi. It's possible that we'll see some of these energy purchases settled in renminbi rather than always relying on the dollar. That massively starts to shift the balance of power in China's favor. Not something to be overstated. It's still way behind the US, but at the margin, it does help. So for all of those reasons, we do not expect China to invade Taiwan. Finally then, worth thinking about the US, this guy, unfortunately, still has massive sway over the Republican Party. That Republican Party has a very decent chance of doing well at the next elections because the incumbent Democrat is seen as weak. The exit from Afghanistan was a debacle. He's been unable to stand up to Putin in the same way as Trump did. And obviously, rightly or wrongly, one is blamed for the inflation situation when gasoline prices rise as sharply as they have done in the US. Why is this significant? Point 3, because this guy is hugely unpredictable. Point 4, however, we have plenty to be thinking about today. We don't think this is one of them. We could have spoken about Iran. There are some other issues out there, but hopefully that covers off the 3 main geopolitical issues that you will have been thinking about with your clients. I think then there is just a couple of slides on who we are, for those of you who have never seen maybe my or Rob's face before. Momentum Global Investment Management has been around since 1998 in London, managing around 5 billion sterling, and we are multi-asset investors. Hence, we hopefully marry an understanding of big global trends with an understanding of market pricing. You need those 2 things to make investments, obviously. We have a range of strategies available to South African investors on a kind of graduated risk return basis if you want something that looks cautious, all the way through to if you want something that is pure equities and therefore much higher risk and return. We can cater for all of those. We indeed have strategies more tailored towards sustainability as well as shown on this slide. So do reach out if you want any more information. And here is a bit of a sense check in terms of how we've done versus peers. It is broadly a good picture across those strategies I showed on the last slide. That gets me to 5 minutes to, which means I think I'm a little bit early, but I think we'll now go straight to Rob. I'll have a chance to look at some of these questions that have come through on my phone, and there'll then be Q&A later on. So without further ado, I will stop sharing and hand over to Rob. Thank you very much.
Thanks, Richard. Hopefully you can see my screen now, but just give me a shout if there's any technical problems. And I'll just jump to full screen mode. And there we go. Again, I'll do my best to kind of keep to time scheduling, but thanks for giving me a bit of extra headroom there, Richard. But let's jump straight in with the investment case for Japan. So I think, I mean, the first thing to say really is we can't really talk about this issue without mentioning Shinzo Abe. Of course, his tragic assassination last month, shocked the world. And I think it's important just to consider how, he was one of the very few kind of democratic leaders about, in recent times that's really had a kind of bold, long-term vision to reform the country for the better. And the road that he set out for Japan has really helped change the discourse politically and economically. And certainly his vision remains very much a work in progress, but there's lots of exciting changes going on the ground in Japan, and I think it's very exciting from an investor perspective. So you can see in the top left, I've just got, I think this is an extract from the FT, just showing the 3 famous arrows of Abenomics: the structural reform, the monetary policy or quantitative easing, and fiscal stimulus as well, which are kind of well known by markets now. And I'll talk to each of these a little bit in turn, and then finish with just to go on to explain why we're so excited about the opportunity in Japanese equities. So this is probably the most dramatic chart that I'm going to show you, and of course this is the first arrow, which is quantitative easing, or more broadly, easing monetary policy. And this chart just shows that Japan has certainly embraced QE. So this is just showing what the BOJ's assets are relative to GDP, and on this basis, Japan looks like quite the outlier. Its balance sheet's risen to 135% of GDP, And they've done this by buying not only government bonds, but also REITs and ETFs too. And part of the reason this looks so extreme is, of course, the denominator has been fairly flat, and Japan's historically had a problem stimulating growth. So any kind of ratio where you're looking at GDP in the denominator can look extreme. And when you actually look at nominal growth or nominal dollar growth of the central bank assets, the numbers are less extreme. So again, it's this green line here, which has been weaker due to kind of currency weakness in the last couple of years or so. But I mean, this really just makes the point that Japan really has been putting its foot on the accelerator, but of course, so has the Fed, so has the ECB, and again, it's just putting things in context. So of course, QE hasn't been the only form of easing. There's much in the papers at the moment about how the policies of yield curve control are working out. So of course, the 10-year is being held at a maximum of 25 bips. And of course, they introduced negative rates in 2016 as well, to kind of mixed success as well. The ECB was also followed this approach, but Fed and the Bank of England have kind of resisted, and they're well away from that in China, of course, which is kind of living through different cycles. But you can't. There's this quantitative easing or monetary policy arrow of Abenomics is very much been in play. And I don't think there'd be much dispute around that. There's of course discussions about how this impacts the economy, and the desired result is eventually to stimulate growth. And of course that has been mixed, but really in terms of asset owners and in terms of allocators allocating to Japan, QE typically inflates asset prices, and it's generally good for asset owners. And we've certainly seen that in the Japanese economy or the Japanese market, but of course the currency weakness has been a kind of offset of this as well, and I'll talk more about that later on. So if we move to the next arrow, which is the structural reform arrow, we can see some examples, and I've put a few examples in here, but I think this is the most powerful trend, and this is really what's been getting us excited about Japan. So historically, as again you're probably well aware, Japanese corporates have been quite inefficient in terms of how they return capital to shareholders, and governance has been well behind the West in terms of international standards, and this is for a number of reasons. Companies tend to hold a lot more cash, and that's partly a cultural issue, conservatism issue, but also I think partly a behavioural issue and a response to some of the big crashes that Japan saw in the 90s, and obviously with the GFC, like everyone else, but particularly the crash of the real estate bubble and the stock market bubble in the early 90s was really significant. And again, you'll see some chart, or you see the stock market return chart later on, which just shows you that the extent of that collapse. And of course, they went through the Asian financial crisis in '97 as well. And that that has an impact on people managing companies. And again, it's not too much of a surprise that they've been holding more cash. And I mean, generally as well, the culture tends to be more hierarchical, less individualistic than somewhere like the States or even the UK. And the labour market has been more rigid as a result. But this chart really shows that what's known as the cross-shareholding ratio. And that's fallen over time pretty dramatically, from 50-odd% in '92 down to 14%. And that decline certainly happened before Abenomics, but there's been plenty of reforms that have kind of kicked that or kept that going, and actually improved in other areas as well. But cross-holdings are typically bad for corporate governance. It's where public companies own big stakes in other public companies. And they're often related, or they're held for kind of strategic reasons. They might be part of the company's supply chain or customers or anything like that. And that makes that pushes other shareholders down in terms of their relative importance and their ability to affect change. And so actually this increase in the foreign ownership ratio is partly a cause of the changing or the improving governance standards, but also an effect as well of the improving governance standards. So as cross shareholdings reduce, it actually makes it much more interesting for the likes of ourselves at Momentum and other large institutional investors to get involved as well. And this is unambiguously a positive trend. You would have read a lot about this in terms of the record level of buybacks as well, and various other elements. But I think the key elements have changed in terms of legislation have been the stewardship code and the corporate governance code, which introduced a lot of, or kind of nudged a lot of corporates into moving into the right areas in terms of appointing independent directors, doing proper proxy voting, and a range of other measures as well. So, of course, there's lots of structural issues to overcome in Japan, but again, Abenomics has been successful in certainly some areas. Again, there's a debate about how successful Abe was with a lot of these policies, but again, I think this is another area which is pretty unambiguous. So, of course, everybody knows that Japan's population is declining. That's what's shown in this area chart in the kind of the light yellow here. So you can see it's kind of peaking out around 2009, 2010, 2011, but it's projected to fall down to 122 million by 2027. So that's not great for growth, obviously. But on the left-hand side, in this red line, you can see that the labour force has actually been increasing over this time, despite the population falling. So part of Abenomics has been to try and stimulate this trend through immigration. That's been difficult with COVID, and just generally, it's difficult for immigrants to adjust culturally in Japan. But actually, the next chart I think explains this divergence quite well. This is the labour force participation rate, which just shows the same trend, the increasing workforce in relation to the population over time. But this next chart really explains that quite well, and this is the female percentage of the labour force. And in 1990 here, if you look at Japan, which is this blue line at the bottom, we started from pretty dismal levels, 40%, and it was something that was again really entrenched in the culture, and it didn't really get addressed until we moved into the 2000s, and then we see this really steep increase here, and that's around when Abenomics was kicking in. And again, that was something that Abe really focused in on as something that he was trying to change and overcome this problem, this wider demographic problem in Japan. And he did this through policies in terms of childcare and tax breaks, and it's really come through in the data. You can also see it through the sort of the caliber of the females entering the workforce as well. So women that are now in the kind of 25 to 34 age range, there's 64% of them now have attained kind of tertiary or higher education degrees. That's compared to 59% of men. And this has meant that there's now many more productive women in high-powered roles in the private sector, and they've been given prominent roles in government as well. So this is, again, unambiguously good news for productivity. And the final arrow is just the fiscal arrow. I think, this has definitely been more mixed. And I think this chart kind of explains why. This just shows the overall debt picture in Japan. And you can see here from the area chart that they've been running a budget deficit really since the early 90s, trying to stimulate themselves after that epic crash. And as a result, you can see that net debt has been increasing. So it's about 170%. And again, it's given that we've still got a fairly wide budget deficit there. It's not going to come down anytime soon. So, I mean, this is certainly a risk and something that we are concerned about, but we don't think it's a major issue. The main thing here is that 90% of debt is held domestically, including a fair chunk from the Bank of Japan as well. And you can see that the rates have remained low through this period. Domestic owners of debt are typically longer term. They're not allocating to different countries. They don't have to worry about FX mismatches and so forth. But of course, this will have to be addressed in the long term. But I mean, if you cast your mind back to when Abe came into power with some of these changes, he spent a lot on infrastructure. building new bridges, and again some recovery from the Fukushima disaster. And he funded that with a VAT increase, or consumer tax increase, which has gradually ramped up from 5% to 10%. And you can see that this has helped to kind of restrain the deficit, and it shows that there are, the government has been willing to be kind of fiscally conservative, despite this additional spending. But of course, COVID has seen that kind of gap out again, and hence this is a risk that we're looking at. But again, it's part of Abe's vision, and it's something that I think the new administration are certainly looking at as well. So this is a chart of the total return of the MSCI Japan Index. And the first thing that jumps out here is that epic bubble that I mentioned, leading up to through the end of the 80s, and then collapsing dramatically in the early 90s as well. And you can just get a sense of how that has impacted not only corporates, but also foreign investors as well. And I think that behavioral impact has certainly left a mark on a lot of Western investors. And I think it's responsible for a lot of the valuation discounts that we see in Japan. But we've only just come out of that high water mark, say in 2021. So that's an awfully long time for Japanese investors to be underwater if you bought in at the peak. Having said that, we've also had a lovely run from 2011 as well. So that's I think the rally is kind of more than 3 times from the bottom. And that's the result of some of Abe's policies. Abenomics is kicking in around here, and quantitative easing has helped. But it's not just the monetary phenomenon; it's also the fact that corporates have been strong, and corporate earnings have been strong as well. The one thing holding back the Japanese market in relative terms compared to the US has been the weakness of the yen. But of course, investors can access this market via hedged means, and given rates are negative in Japan, if you're investing from the US and you hedge your returns, you can get paid to do so as well. So it's a very exciting market, but you have to be careful with your view on the currency. This is what's happened to real GDP over the period as well. So again, you can see growth really coming down, heading into the 90s, the result of this crash. And really, it's been pretty unexciting since. There have been times when growth has ticked up and provided some optimism. So initially, Abe's coming to power and his kind of fiscal spending helped push growth towards the kind of 3% number back in 2013. But then the consumption tax and various other crises, and eventually, of course, COVID, have caused this kind of zigzagging, and ultimately, despite this bump here up in the moving average, we've been dragged down by the recent depths in terms of COVID. So again, it's not as successful as we would have hoped here, but I think looking forward, there's real grounds to be optimistic, and that's partly coming through the inflationary picture as well. So historically, the major issue holding back the Japanese economy and Japanese growth has arguably been deflation, and you can see that here. So we've just got the CPI index, and the CPI growth rate, and then we've got the 10-year moving average in the dotted blue line here as well. And you'll see, although through this period in the noughties, we've got 10-year periods where the average inflation has been negative, which is an extraordinary thing, and certainly for us in the West and in emerging markets as well. I'm sure a lot of you guys will be familiar with positive inflation and the problems of high inflation, and lots of people don't consider the impacts and the really disastrous impact that deflation can have in terms of consumer behavior and expectations. And if you look, if you just think about it kind of logically, why would consumers spend today when you know that the price of goods is going to be lower next year, and extend that over a kind of decade-long period? And similarly, if you're a business owner, why would you give your employees a wage rise when you know that your margins aren't going to be increasing, and anything that you pay away to your employees is just going to take directly out of your profitability? And although and we have seen a bounce here. So of course, we're in a very different world now, where inflation is more of a problem. And you can find instances of that coming through in Japan. So my favorite example was an international news story that came out in July when a snack, I think it's called Yumeibo. So forgive my horrible pronunciation, but it's a Japanese kind of corn-based snack which sells for about 10 yen. So they had to increase their price by a whopping 20% to 12 yen. So which is basically nothing, but that made headlines everywhere. It's the first time they've had to raise their prices since 1979, and those sorts of stories are kind of coming through, and you can see it's kind of clashing with traditional Japanese culture. And of course, this big spike at the end here is what is causing that. And don't forget that Japan, of course, is now much more reliant on importing foreign energy, given that they have less nuclear capability than they did 10 years ago. So they're not immune from these inflationary pressures, but they're certainly, these numbers are nothing compared to what we're seeing. In the UK, you've got double digits. The US is still high, although it looks to have peaked. So again, Japan certainly doesn't have an inflationary problem. And in a world where inflation is a concern, actually, you can make the argument that a bit of inflation is good for Japan, because it removes this demand destruction that comes through from deflation, and actually should hopefully trigger some growth in the economy, some real wage growth, give the ability to kind of corporates to kind of pass on these costs a little bit more. And again, we'll see how this plays out. But again, in terms of Abenomics, there has been a trend of increasing inflation here. So I mentioned the valuation story. This is pretty compelling no matter how you cut it, but this is the favorite chart that I like to look at, which is a relative chart relative to the US. And again, the first thing that jumps out is that yellow line. So that's the relative price to book of the US to Japan. And it's pretty much at its lowest level ever. It's had a little bounce here, and we've seen some decent returns in Japanese equity markets. But if there is any kind of normalization, you'd expect valuations to improve from here. And we've shown the same chart for PE in the pink line, which is a little bit more volatile, but certainly there's a similar trend. So I mean, you would have heard tons of global equity managers making this case, and you could have made the same case in 2014, 2016, all the way down here, and actually, it would have paid to be in US dollar assets certainly. But what's changed here? Is this a value trap? So firstly, I would make the argument that this picture looks so attractive now that the downside is capped. These Japanese equities can't go to zero. But also, there's plenty of evidence out there, building on some of the reforms that we've spoken about, that things are changing and things are certainly improving on the ground. And the main reason for that is these corporate reforms, which I referred to earlier, and these corporate numbers have been pretty resoundingly positive. And this is the example that kind of gives us real optimism. So these are the return on equity charts that we plot when we're doing our valuations, and Richard showed some of the outputs to those earlier. And Japan on all of those scenarios looks pretty attractive. And that's partly because of this return on equity number. And the way this is constructed is using an equally weighted basket of companies. But it's the same if you market weight or market cap weight the index as well. And you can see this improving trend, and it's pretty obvious. And in fact, if you look at the 5-year moving average, that pretty much coincides with a lot of R-based reforms as well. The other thing that makes this particularly attractive is where Japan sits relative to the rest of the world. So the US numbers are a fair bit higher. They're much higher if you look at it on a market cap weighting index, where you're looking at the FANGs and so forth, because of course they skew ROE numbers higher, towards the 18, 19, 20%. It's really quite amazing. But the point is that Japan has so much scope for this to move higher. So this trend line could well continue. Our most optimistic case is for the next 5 years for the ROE to move up towards 11, 12%. And if we see that would certainly, in our view, be enough to kind of trigger a re-rating in terms of the valuations as well. So you can have a kicker in terms of earnings, you can have a kicker in terms of valuation, and you don't actually need to see much sales growth. If you get sales growth as well, and you see the Japanese GDP story switching, you could get excellent returns from Japanese equities from here. And in the downside scenario, given where valuations are, so if we do see this kind of revert more to history, we think relative losses are capped, and that's a pretty attractive opportunity for us. So in the remaining minutes I've got left, I'll try and touch on the yen issue. I'm sure there'll be interest here, but you can see the weakness in the yen, which has kind of derailed this unless you've been currency hedged through this rally in Japan. So it's looking pretty cheap, but I would say, over this period, the yen dollar pair has been pretty range bound actually, and there's certainly been reasons here in terms of the divergence of monetary policy, but I would argue that looks like shifting. We've seen what looks like the kind of peak inflation pass in the US, and actually monetary policy in Japan, as we've seen, is still very loose, and there's the opportunity for that to change, not dramatically perhaps, but to change at the margin in terms of the yield curve cap and perhaps moving away from negative rates. And that could happen next year as Kuroda's term at the Bank of Japan ends in April 2023. And we think that the sentiment towards the yen is so negative at the moment that any kind of marginal change there could be pretty profitable. So we're taking the currency position in our portfolios. We think that's pretty attractive right now. We've seen a bit of a bounce here, but again, we think that's pretty small in terms of what could come. And that's partly backed by the external position of Japan, which is summarized here. Really, the quick version of this slide is that Japan obviously runs a healthy current account surplus, and it has done throughout this period. They're a well-known exporter, and they've also got $1.2 trillion in FX reserves as well, so the currency is well supported. And if we look at it in terms of purchasing power parity, it's also well supported. You'll see here, we've got just the G10 currencies on here using the OECD purchasing power parity metric, and it's 9th there, second only to the euro, and it's about 34% undervalued. So in the last just 30 seconds or so, this is Moran Wright, our favored Japan manager. They've got an all-cap focus, Japanese equity specialists, and they really tick all the boxes in terms of what we look for as active managers in the space. They're a boutique culture, all hugely experienced. Japanese speakers, they're in touch with the culture and what's going on the ground. And I mean, crucially, they're focused. This is all they do. They just manage Japanese equities. And they give us exposures to domestic companies with a mid-cap bias. And these companies are not the big exporters. They might have some exposure to some exporters, but a lot of it is these mid-caps, and they are geared towards the performance of domestic Japan, Japan Inc. We think it's a great place to be, certainly over the long term. But even if you look year to date, they've protected relatively well. Again, in a tough market. So this is all in dollars. So Moran Wright outperformed Japan and MCI AC World. But again, if you convert this to yen, these numbers kind of become positive and shift up about 10% or so. So again, our currency call year to date has been the wrong one. But again, looking forward, we think that again the return prospects, both from Moran Wright and the Japanese yen, are pretty attractive. So with that, I think I will stop and pause for some questions. And I think we're going to bring back Richard as well. And please feel free to challenge us on anything that we've said, or again, if you think I'm talking rubbish on Japan, please do interject and throw a couple of questions our way. So I can't see the chat. It looks like there's no questions. Unless there's any I've missed. You're seeing there, Richard?
I'm not, Rob. I think Nats will join us momentarily. She might be able to see some. There have been a couple on the phone, which I think we've responded to. So anyone who feels like they've asked a question that's not been answered, please speak up now. But I think we just want to bring back Nats momentarily.
Yeah, and we can always, again, if any questions do come to light after the fact, we're very open, and we can. You saw our forecast numbers in our different scenarios. We're open with investors and with interested parties. So please feel free to reach out to Nats or one of our colleagues.
Rob.
Hi, Nats.
How's it, Rob? Thank you for that. There has been a question. There's been a few questions. So firstly, how do you envisage the growth in China going forward? So yourself and Richard, I suppose, can talk to that, because Richard covered China a bit.
Yeah, it's slowing, right? It's not. It's probably the sort of, you probably already knew the answer to that, so it's probably not shedding much light. But this is a picture that's been happening for a while. I think a lot of it is natural when you consider where China's been coming from. They had this great period of growth after they joined the WTO. That sort of, that's the emerging market type growth. But they're now looking to transition from a emerging market economy towards a developed or more developed economy. And they've got all the political problems now that are coming with the rise of a new power, which are complicating things. But they're coming to an important point now, because it's very difficult to make that shift from a investment-driven economy to a consumption-driven economy. They've got great companies there. All the tech companies are excellent, but of course the CCP is been reining them in a little, and that's a delicate balance, and we'll see how that plays out. It seems like they've got to the end of their kind of regulatory tightening cycle. So I think there's a lot of pessimism that's in the price now, frankly, and a lot of pessimism that's in there in terms of Chinese growth. Even in pessimistic scenarios, as Richard showed, the World Bank is showing decent growth in emerging markets, and the equity markets have been hammered. So it's China's slowing. That's natural, and it's expected. Obviously, the real estate sector they need to get that going again. That's a headwind for them at the moment. We think they're making the right sort of changes there now. You see their language towards the real estate companies are changing, and to the debt investors that have financed that are kind of changing as well. As long as there's no big policy missteps there, and we don't think there's any reason that there would be, I think China can grow out of this, and it's an integral part of the world economy. And so this interlinkage between the West and China is going to continue to be there, in my view. And growth is going to slow, but it's not going to be disastrous in our view.
And Rob, we've actually increased recently our Chinese equity exposure within our asset allocation funds. I don't know if you want to just quickly touch base on that.
Yeah, so we've added again another boutique specialist. They are got excellent returns. They've really captured the growth cycle, and they've been defensive on the downside as well. It's buying into the fact that we're being paid to kind of price risk and take risk in sensible areas. We think there's a lot of pessimism that's out there in China. People are assuming that the CCP, the Chinese Communist Party, are going to destroy growth. The economy's slowing, the real estate sector is going to collapse. And at these periods of maximum fear, I think it makes sense to take a little bit of risk. And again, if you look forward and you consider the interconnectedness of China with the world, and the growth trajectory, and what they're trying to do, and generally, most of what the policy that the CCP has enacted has been very sensible in terms of fostering growth. The whole economic growth story of China has been a kind of economic miracle over the last 20 years. There's a chance that goes wrong, but I think we're more than being paid to take those risks at the moment.
So thank you. Another question: given significant import propensity in terms of commodities and energy, where would growth come through in a sluggish global growth environment?
Can I say that one, Richard? Or
I didn't quite hear it. What was it? Given import sensitivity to energy?
Yeah, 100% commodities and energy. where would growth come through in a sluggish growth economy environment?
Sluggish growth economy with rising input costs. I mean, this is the challenge we face today. I would suggest, this is precisely where we are now. Thankfully, on the one hand, the energy intensity of production is lower than it was. Otherwise, we'd probably find ourselves in a 70s type scenario. But it goes right back to a question I saw at the outset, which is, what on earth do you do if the inflation problem we have today is being driven more by the supply side than by the demand side? And I think that's exactly the right question. And it's just going to take time to work itself out. So we've got to manage demand down, and then periodically we'll probably see central banks roll back a bit on interest rates and try and let that demand go. And at that point, you'll see either the supply side has corrected sufficiently that we can start growing at a normal pace, or you're going to again run into the capacity buffers and you're going to get inflation. So specifically, as I say, the last time we had high oil prices, it prompted a shale revolution. It's these alternative sources of supply that need to come on, and indeed will come on. Bigger emphasis put on renewables. We're already seeing that. That's going to be turbocharged. So longer term, energy prices are going to come down. Shorter term, absolutely. It's trickier. The one other thing I'd point out is that, and it is rather hard to disaggregate, and I want to actually spend a bit more time on this, but there is a lot of speculation that goes into commodity prices. So, there's the kind of need from companies to procure the energy they need that goes into production. And then there's, I was going to say idiots, maybe that's not right, but there's a whole financial community out there who are also speculating on these things, and that's not helpful. And that's why you often see relatively small changes in supply and demand, i.e., 1 week print from China in terms of quarter-on-quarter growth, and it has this multiple, massively amplified impact on certain commodity prices and stuff like that. So yeah, in short, we need a supply response. It will definitely happen, but it will take time. And number 3, thankfully, in the short term, we will see some speculation come out, as we already have done, and that should help improve those input prices, and that should make growth that much easier.
Awesome, thanks. I think just one last question, and then we must, I'll sign off. But obviously, Japan has been cheap for a long time. Why is now a good time to invest? I know, Rob, you've covered most of those points, but if you can just summarize all your points. The yen is cheap, attractive corporate governance, compelling return on equity. What would mean the main things that you look at currently in terms of the driver returns from this region going forward?
I think you've just summed it up, Nat. I think that's 3 of the key areas. I would say trending higher return on equity. That's the and there's space for that gap to grow. Combination of again, improving governance, improving return on equity, strengthening currency, and just being more attractive as a kind of low inflation or traditionally low inflation market in a high inflation environment. That can all trigger the valuations to go higher as well. So all those things combined, then your upside is significant. And then on the downside, yeah, I mean, Japan could get cheaper. It's not going to go to zero. So that the downside has been limited with this underperformance over the number of years that we've seen. So we could get our timing a little bit wrong, but I think it's a good bet over the long run.
Awesome, thanks. Thank you, Richard and Rob, for your time as always. Just to sign off again to everyone who's attended today, we so appreciate your time. These investment masterclasses are intended to happen every single month. We always have the local version at the beginning of the 1 month and the global version around the 3rd week of the month. We will be taking a break next month, though, in September, because we have our annual think tank conference, which will be taking place on the 28th, 29th, and 30th of September. There are morning sessions on each of those days. And what's important with this conference is that we are showcasing some of the specialist asset managers that we have partnered within our funds. So as an example, we've got some of our private equity managers Richard made reference to Schroders. We've got Ashmore, one of our emerging markets debt exposures. We've got Hotchkiss & Wiley, one of our value managers. Richard spoke to value earlier. So we've got some exciting specialist managers across the asset class spectrum who's going to be talking at that conference over those 3 days. So we hope that you'll be joining us virtually on the 28th, 29th, and 30th of September. Just the sign off from me will be a little video to give you a bit of insight into what Think Tank is all about. So just please watch the video, and otherwise from Richard, myself, and Rob, thank you for attending. There's no sound on the video.
World's leading financial center and has been held there for the last 20 years, with the exceptions of 2007 when we chose New York and 2010 when we ventured to Hong Kong. Think Tank is an event designed exclusively for investment professionals and institutional investors. It is a true collaboration of investment specialists providing independent, non-conflicted views and opinions, achieved by avoiding sponsorship and other financial promotions, and with the aim of sharing knowledge and ideas, giving Think Tank an excellent reputation within the investment industry. Originally designed to provide our South African clients with a global, independent perspective on investment matters, Think Tank has gone from strength to strength, and delegates now attend from all over the world, making Think Tank a truly global event. The combination of independent thinking, thought leadership, idea generation, and depth of analysis supports delegates in their quest to achieve their own clients' goals. The first conference was held in 2002 in the heart of the City of London, the world's leading financial centre, and has been held there for the last 20 years, with the exceptions of 2007 when we chose New York and 2010 when we ventured to Hong Kong. In pandemic-ravaged 2020, we held our first virtual conference, which was a huge success with over 1,000 delegates online. Think Tank aims to cover topical events in the global economy and financial markets, with a particular theme each year based around the most important issues facing investors, as well as exploring longer-term perspectives on investment opportunities globally. Each year, we invite a range of outstanding and experienced speakers from around the world, including strategists, economists, investment managers and analysts from global investment banks and specialist asset management firms. We carefully select the topic for each speaker to make sure we offer an unrivaled variety and depth of analysis and strategic thinking. Book your seat for Think Tank 2022 in the heart of the City of London.